Hey, greetings. Happy Tuesday, September 5th, back to school special of sorts. We are basically through summer. August has definitely wound down and we are into end of year, and folks are hopefully up off the beach and in their chairs and gripped by market action. We'll see what we see for September and rest of the half of the year. Basically, this is your macro to micro power hour. I'm Samantha LaDuc, founder of LaDucTrading.com, and I have with us our MacroAdvisor EDGE manager, Craig Shapiro. How are you doing, Craig? How was your summer?
Doing well. Summer was good, and I live in Florida, so summer's not over, at least for me. But
that is
but I do have to survive hurricane season, so we already missed the first one, but got another couple months left to go. So.
All right. Well, yeah, I'm Boston, so we're definitely going to get hit sooner rather than later with just winter weather, and then I won't mind doing these. So for right now, let's kind of recap. We've talked obviously about doing this kind of ask us anything format. So even though we deliver our bi-weekly and weekly, I do daily live trading room, but we do sessions for clients all the time on the macro event risk and positioning and sector rotation and all that might be percolating up in the market for change in currencies, fixed income, and equities. But you are managing lots of that client one-on-one engagement, and I run a live trading room. So we're really just coming together this type of format for the public, kind of ask us anything. So we're going to let you know that we've got Zoom chat or Q&A open, and really, we covered the gambit, all asset classes, all time frames. Just let us know what your question is, what you're thinking about, and where you kind of want us to focus. So, Craig, let's kind of catch up with some of the macro movers, moving events, and also we've got the ISM tomorrow, so maybe a little volatility might come into markets then. But what are you expecting?
Yeah, look, I think the biggest thing that I see, maybe the most important thing that I see right now, is this breakout in oil. I think this is something that really needs to be respected, understood, and the implications that oil can have on the dollar and on yields, I think is very, is very interesting and very timely. So I think, oil has been range bound for most of the year, although I suspect most people probably think it's, trading better than we otherwise would have thought in light of the China slowdown, Europe stalling, U.S. manufacturing and recession. So, but oil has kind of hung in there all year. And I think it has a lot to do with, OPEC plus keeping barrels off the market. Obviously the U.S. has drained down the SPR to, 40-year lows. The rig count is falling. And so our ability to kind of deal with an oil price rise right now is not great. But now you have this news from Aramco that they're going to be raising $50 billion. And all of a sudden you get the follow-on headline today that Saudi's going to keep barrels off the market for another 3 months, and Russia's going to keep barrels off the market for another 3 months, and highly coordinated to help Aramco raise that capital. So expect oil prices to, remain firmer than not. And I think what that's doing today or what it has been doing over the last few days, and it certainly today, I think was a little bit of a rip the Band-Aid off moment for the bond market and for the dollar. I mean, we really saw kind of very strong moves in dollar versus DM currencies like the yen, the pound, the euro. These energy importing currencies are very much at risk here to a rising energy cost environment. And in order for them to, pay those elevated US dollar expenses of increased energy, they have to find dollars, and they're going to be selling treasuries in order to do so. So we kind of have this follow-on impact of yields up, dollar up, getting yields up further and dollar up further. We obviously have talked about just the treasuries issuance calendar accelerating here with deficits that are blowing out. You had a big Washington Post article over the weekend that talked about the deficits, and so growing, and what does that mean? And I think it's becoming more top of mind when you're seeing articles in the Journal and in the Washington Post about the struggles of the U.S. government's deficit position and what that might mean for the Treasury market. So I think that momentum is continuing, and I think that's part of the reason why we are seeing yields move higher, despite last week's largely weaker than expected labor market momentum. Friday was the payrolls, came in a little bit lighter, although wages were we're okay. But since then, since that bond market rally we saw last week, yields have started to turn around and are kicking off higher here to start September. So, but I think oil was the catalyst. I think oil was the linchpin to, from Friday into today. And I think folks are, as they get back to their desks for summer, are have to deal with this elevated energy environment where headline inflation is picking back up. What does that mean for the Fed? What does it mean for bonds? And we can, get into all that.
Well, I'm really interested in Saudi's kind of $90 price point. It sounds like they want that come hell or high water, and they're going to get it. So taking just a moment on the oil trade, we still have a massive intervention caller. That's Robert McMahon's kind of term for oil, though. It's not really allowed to go up too much. So we're obviously getting barrels taken off the market, Saudi Arabia and Iran, Russia, but we still have the very real potential of U.S. government, White House, right, coming in and stepping on the necks of the oil traders in the same way, Bank of Japan for sure in this percolating dollar yen move, which is really igniting the gold trade lower. For me, is also an intervention caller where they've already promised, right, if we get up to 151, 152, they're going to come back in. They're going to defend their bond market for sure. So we've got some intervention currency and assets that are tough to get too excited about the long end of this. And for me, that's what I'm looking for, is when are they going to come in and actually start to hammer that down? But in the meantime, there has been some strong support in both the oil and higher yield move, which shows that QT that you're talking about is playing a part, because typically when they're doing a little bit of easing, even if it's stealth easing, you don't see yields moving higher with oil. Both are with the dollar. So the dollar is the one that for me has the most interest. We have literally had 6 green weekly closes in the dollar. And this obviously today is very strong. So it's extended. We're pushing above a key technical level 104.5. That was really exciting actually today to come in and see that it held so well. That's a headwind for equities, but the equity market isn't really responding to the bid in a dollar or yields or oil. So we'll have to watch that closely. But tell us how you see some of the economic data coming in this week, and where that higher dollar yield and oil trade might be supported or obviously hit some volatility.
Yeah. So I think it's the data. We have this pendulum, I believe, where the labor data. So the Fed has dual mandate. It's a labor mandate and it's an inflation mandate. And I think what we are having is when we get labor data, and largely when we get like manufacturing data, PMIs. We have weaker than expected data, which leads people to believe that, okay, the Fed's done. The Fed is going to be loosening policy. It's going to arrest this growth decline. And then after that data comes out, then we kind of flip to what's the next data point? That's inflation. And the inflation data is not really showing, enough momentum that we're going to get back to 2%. And so then the market says, okay, the Fed's going to be higher for longer, and if not higher, then certainly longer for longer. And so I think what we got last week was, on the PCE, a little bit, weaker than expected, but on the super core, a reacceleration now back to a 3-month high. And with oil breaking out and with wages remaining very sticky, the prospects for next week's CPI print now are, going to be high again. Cleveland Fed's looking for a 0.8% month-on-month gain, which will be the highest, in several months, and back to, 3.8% year over year. And their September forecast now is looking for 0.5% up month-on-month and 3.9% year on year. So you basically have this positive momentum. It's kind of what we talked about a few months ago, which that June's print would be the low print. Mm-hmm. And we'd see an acceleration of headline inflation prints in August and in September that would make it very difficult for the Fed to declare all mission completed on inflation. And so while the Fed doesn't necessarily look at headline inflation as the reason to dictate policy because they want to look at core, because headline is more transitory than not, it would be extremely idiotic. I don't know, but certainly rare for the Fed to kind of declare an all missions complete on inflation as headline is reaccelerating here in an oil price environment that is doing what it's doing, where gasoline prices are, basically making multi-year highs for this time of year. So, the rest of this week on the data front, we don't really get much. Tomorrow there's a services PMI. We'll see how services momentum was. I think, August, with the market being a little bit worse than expected, there's probably some risk to the downside there. Although I don't really think now that there's much, anyone's really caring too much about this. And then as far as the central bank speak is concerned for the rest of the week, there is some speak later this week. Logan speaks tomorrow. Collins speaks tomorrow. And then interestingly, Williams will speak on Thursday, Bowman on Thursday, Bostic, and then Logan again. So we'll get some more Fed speak. Waller was out this morning. He's a little bit more dovish than he has been, kind of saying, suggesting more data dependency, but we'll see how the rest of the, these folks are thinking about things. But with oil prices reaccelerating and headline inflation moving back higher and inflation expectations potentially becoming unanchored again, I think the Fed's going to be more likely to signal a longer pause, for lack of a better word, than not. I think that will show up in the in the 2024 dots when that comes out in a couple of weeks.
You had mentioned Lori Logan is speaking tomorrow and then again later on in the week. She's one that had kind of floated the idea of moving the goalposts, basically 3% inflation. But she's also new there.
Yeah, I mean, I think Powell kind of
ended that again in the narrative.
I think Powell ended that on Friday. I don't think there's going to be any.
It was very stern.
Yeah, I don't think there's going to be any talk of from the Fed about moving the goalposts, at least for the next couple quarters, if not year.
Not while he's there.
Yeah.
Basically. All right. Thoughts on the 10-year yield trend or peaking soon? Yours, and I'll share mine.
Yeah. So I was thinking, and I've been negative on bonds for quite some time. And that move kind of accelerated at the end of July, early August, with the Treasury's refunding announcement, where Treasury announced, an acceleration of duration issuance. And so, had a nice trade there, short bonds. But then last week with the data, and given how much bonds had moved, I took that trade off. I just kind of was like, I'm nowhere here on bonds, because, the muscle memory of buy duration when growth is a concern is very strong. Folks continue to, to kind of play that out. But look, with the deficit situation, accelerating and duration issuance continuing to grow, and foreign demand for treasuries slowing down, and oil prices breaking out, there's still likely to be upward pressure on yields. It wouldn't surprise me if, after another strong inflation print next week, yields are 10-year, 30-year yields are back to the highs of the year. There's also, there's also a 10s and 30s auction next week. So it will be very interesting to see how that plays out. But I think yields are headed higher. I think term premiums are too negative. Inflation volatility is elevated and growing, and there's risk there. And the U.S. economy is kind of hanging in there, still pretty good. So, and Abe has been able to handle a lot of the rate hikes so far. I mean, it's starting to show cracks, and that's what the Fed wants. But it's still not clear to me how the Fed is going to engineer us back to a 2% inflation regime unless they're willing to go kind of all in here on tightening and taking us into recession. And so far, it doesn't really seem like that's where they're headed. So it seems like the long end of the curve will react accordingly, and that's with yields likely moving higher.
Mine is very much, and it has been technical, right? So this move into 4.7 has been my baseline bet for this year, and we obviously aren't there yet. We had a very that I made last year. We had a very strong central bank coordinated intervention back in October of 2022. That whole time frame. When September, actually, the Bank of Japan did its first very large yen intervention, first time in 24 years. And then that the gilt blew out, and the whole thing just basically coalesced, and we had intervention globally by central banks, and that was all that September, October timeframe. So bonds are basically right there. So bond bulls need to defend, but I think that's going to break, and yields are going to move higher. But it's not because of oil. That was a thesis way early on, oil as an inflation hedge, and it's worked really well from summer of 2020, but not right now. I actually am a little skeptical of this move higher in oil. Again, I think this is very much short term, coordinated to for those counting barrels, they're very excited, but for the actual event risk of Saudi getting their $90 price point and then flooding liquidity into the market, and that just turns into a fabulous short, I think there's absolute risk there. So I'm not using oil as my baseline bet for why yields move higher, but I am impressed that yields and oil are moving higher together, because that kind of shows there is some tightening in the system, and you lay that out very, very well every day for clients by tracking that, and the TGA and RRP and all the alphabet soup of issuance. So for me, this is a very strong technical continuation pattern. Nothing has changed that, except for the $1.5 trillion worth of liquidity that Matt King from Citibank basically had calculated from that October intervention, and it had diminishing rate of return. So liquidity is waning. You've talked about the Treasury issuance. Oil, all of a sudden starts percolating higher, and everyone knows that that's going to impact inflation expectations. It is kind of a little earlier than usual, but it still, to me, smacks of bonds are just in trouble. They kind of smell that the higher costs, inflation staying sticky, wage inflation, it has definitely continued to stay strong, even if the unemployment rate did move from 3.5% to 3.8%. They've had some very large revisions. The wage components have stayed very sticky. Unions are part of it. The UAW is next up in regards to their very strong negotiations. So I think the bond market basically smelled that early, and has continued to kind of suffer under the weight of it. And I don't see anything slowing that down, except potentially another coordinated event like October 2022, or the March backstop by White House, Fed, and Treasury, or some kind of reversal of this tightening that's going on. So right now, no, it looks very much like the only one who's really strongly easing or trying to ease, it's not really outright stimulus, is China, right, in their capital markets, but they're not necessarily doing it through kind of monetary or fiscal intervention. It's very much trying to excite sentiment by the consumer and by their stock market. And it's not really working so well, but positioning has been strong there for several weeks, and they're trying to get going. So anyway, the point is, I definitely think that there's some countries that are kind of now slowing down, pause, while the Fed considers its options. But I don't think they're going to hike in September. This is still, for me, a pause. Anyway, I agree with you on definitely the dollar. I thought it would be tempered by now, given 6 weeks of strong green closes. But we actually today we got above that 104.5 on Dixie, and if we stay there, we're definitely moving up another buck. And equities haven't kind of felt it yet. On the other hand, if we pull back quickly, we do have a gap fill in SPX to about 45.75. So that is from August 1st when we rolled over. And that date followed perfectly with your July 31st quarter end Treasury review, where you had on this video, right, a month ago, had basically said it was massive. So we recovered, obviously, post NVIDIA earnings. But what are your thoughts as far as on the Treasury issuance, since that definitely spooked the market and equities started pulling back down as the dollar moved higher?
Yeah, I mean, so we get that data point, every 3 months, which is the Treasury's issuance calendar. And the Treasury, I think, was fortunate that they were able to do kind of the first round of duration issuance in August. while the market was a little bit soft and while some of the data came in soft, so the yields kind of came down, kind of benefited them in their ability to get those done pretty well. And so now we're into September and they have, they're auctioning, more bonds and more bills again. So for September, and then again for October, and then again for November, and every month from here, they'll be, offering, more bonds than the prior month. And that's going to continue. We'll get the next update on the amount of that duration in November for the first quarter of 2024. But the deficits continue to rise. And Treasury has a lot of paper to issue because there's no ability for the government to tax more or to spend less. It's, the government may or may not shut down at the end of September, but, they'll do a continuing resolution for a week or 3 or 6 or 8, whatever it is. But the prospects of doing any significant fiscal reform are basically zero. It's because there's no ability to cut entitlements and there's no ability to cut defense, and the Republicans have said there's no ability to raise taxes. So the only way we're going to continue to fund this deficit is through increasing the debt, and it's going to be a combination of bills and bonds. And given the ratios that we have, the Treasury's going to be issuing more bonds in order to put the ratios kind of back in line. And as we accelerate issuance of duration, that money needs to come from somewhere, whether it's bank reserves, whether it's out of other asset markets, and that's leading to this kind of yields up, risk off type construct, which I've been pointing to. So I think I'm still thinking that is the way forward. Nothing really has changed on that. We'll get a next budget update for August will be next Monday. So we'll see, what the momentum there was. And again, I think people are now more attuned to this data point, right? I mean, we've crossed the Rubicon so to speak, as far as people's awareness of this deficit and this duration issuance and what does it mean and what is it doing for fixed income and who's going to buy it and what's it doing for yields. And I think that pressure on yields is going to continue from the supply side, over the course of the next weeks and months.
And oil only helps it move higher, but ultimately we have.
I think the oil dynamic is one. I think it could go either way, right? People could believe that oil prices moving up is going to be, lead to a recession sooner, and so there'll be a demand hiccup. But in light of the labor market momentum that we've had, it's unlikely that we're going to see any real, tangible drop in oil demand here. And so it's more likely the flip side, where the oil price moving up kind of unanchors inflation expectations and kind of forces companies to react by raising prices and leads to more inflation, which is why I think the bond market is, ripe for risk. The other issue is that our developed market allies in Europe and in the UK and Japan are having kind of energy import bills that are exploding as their currencies are weakening and they have to find dollars to buy this incremental energy. They need to sell assets in order to raise dollars. The asset that most likely they're going to sell is their treasury holding. So you kind of get this reflexive, deal where yields up to help slow down their current. This is what we saw last fall, right? This was the yen was moving higher as energy prices were very strong. Back then, it was a little bit more on the LNG side, but now gasoline prices in Japan are, multi-decade highs. So we have a little bit of a repeat here where an energy price escalation is leading to a strong dollar and leading to countries who need to get dollars selling dollar assets in order to get those dollars to pay for their increased import bills.
Well, they're not selling equities in big tech, which was one question. Agree with Craig on US dollar and yields. What are your thoughts on why these three are not affecting US markets, especially big tech? I've got 2 words: negative gamma. We're not there convincingly yet with power. That's when we actually have selling more than just, for intraday. Your thoughts on big tech holding up?
Yeah, look, I think that big tech benefits from, I know this sounds crazy, but the more you think about it, there's a positive earnings impact to big tech's cash position in a rising rate environment that is offsetting the historical multiple compression that you'd expect to get from a rate hike rise. And
but not just exclusive to big tech, Exxon and other.
But for sure, the
Yeah,
most of the cash of the S&P, is in these big tech companies, and I really think that they are benefiting from this dynamic in play here. And as you raise the cost of capital, they don't need capital. They have excess capital. They have plenty of capital. And so they're not really being affected by this interest rate increase in a negative way. Now, there are plenty of other companies in consumer discretionary and retail and in unprofitable tech, which are drastically underperforming. And that makes a lot of sense to me. Small caps as well should be the most exposed to a rising interest rate environment. They have the least ability to procure capital. They're most tied in with regional banks who are not lending at an increasing rate. So I think that makes sense to me. Why I'm pretty sure today NASDAQ versus IWM has made a new high for the cycle, that ratio today. So I think that's the reason why big cap tech it continues to outperform. And until it breaks, or until we get something more structural on the systematic side, where we have a negative gamma position, vol control funds are selling. We did have that for a few weeks in August, and it didn't play. And it doesn't, just because the window of weakness was open doesn't mean that it stays
open.
That doesn't, right? So, and now we're closer to the September expiry, where there are going to be some kind of regular buyback flows with S&P options, and so it'd be harder to break S&Ps and NASDAQ ahead of September 15th, but maybe on the second half of the month, when that positioning is cleaned up a little bit, and we have this impact of a pretty sizable negative liquidity drain from the TGA building, $300 billion in the next 3 weeks. Maybe that's a reason for that to finally crack. But in the meantime, IWMs are underperforming. Overseas ETFs are underperforming because of the dollar move.
Yes.
So they're regional banks are underperforming. So there are things that are not working in this environment. So it's not a unilateral, like the market doesn't care. The market does care. It's just you have to find where it cares.
And energy as a sector has been very, very strong since mid-July. Uranium has been also very strong. Sweden, Germany, Japan talking up nuclear again has helped that space. So those are very durable themes. One that came up off the ground last week was the pot stocks, the cannabis space, on a potential reclassification. But that is a perpetual short for many because it's likely to be unwound. But it's strange that those are the three strongest sectors this morning, other than VIX, which had a nice oversold pop to start the new week and back to school. So I think one of the reasons we also haven't had any really gyrations is NVIDIA. We just had that earnings, and that excitement around the best earnings report ever in the history of earnings reports. So there's a little bit of excitement still in that safety trade, right, of mega cap tech. Plus they are cash cows. And that's actually a great ETF for anyone who's not familiar with it. It's COWZ, and it's actually, it tracks, and not all of them would I recommend, but nonetheless, the top kind of 100 cash cows of the market. So that's kind of a fun one. All right. So a question on the kind of wage inflation, or I should say recession risk. Some economists, Raj is asking, say rise in unemployment recently is not a concern. That doesn't make sense. Can you let us know your views on this? And is this a precursor to recession? So what are your thoughts on that? Mine, I've already written about them extensively.
There was a decent tick up in the unemployment rate from 3.5 to 3.8% on Friday. The big driver of that was an increase in labor participation, more people kind of going back into the workforce, as opposed to from jobs being eliminated. So currently, is 3.8%. A year ago, we were at 3.7%. So there really hasn't been much in the way of labor market deterioration over the course of the last year or so. I think, I don't know who's thinking that a big rise in unemployment would not be a concern. I think it would be a concern. And historically, when we get kind of big tick ups in the in jobless claims, and then we get big pickup in the unemployment rate, it is usually a precursor for a recession. I think this time the labor market is exhibiting a much larger degree of durability versus what you would otherwise expect from this interest rate hike. And that's because corporate America termed out, a good chunk of their debt during the the COVID crisis, and is dealing in a world of very low borrowing costs without any maturities coming up. There are some, really no maturities to speak of for most of corporate America this year. There'll be an increase next year, and the big wave kind of starts in 2025. And as far as households are concerned, a good chunk of homeowners kind of termed out their mortgages in 2020 and 2021. So they're not facing the same type of issues on the borrowing cost side. So we're not getting yet a consumer that is weak enough, or companies that are weak enough to start laying off a lot of people. So that's why I think the labor market, hasn't been as receptive to these rate hikes yet and slowing down. So, but to the extent that, the labor market data we saw last week starts to accelerate, and we get more layoffs, and we get more shutdowns, and we get more, concern, then I think it's going to be an issue for the economy. And, we could pull into recession sooner rather than later. Just haven't really seen the pickup yet in claims to be worried about it.
We haven't. And I just, posted a piece that I had written on wage inflation, delayed recession. And these are kind of the tells that I'm looking for. There is the SOM rule for those who are interested. This is basically things that start to make me go, I'm worried the recession risk will be pulled forward, and productivity falling further relative to wages as economic growth materially slows. Wage price spiral, narrative fears trigger more Fed hikes or tightening. Not seeing that. There's pause in my crystal ball. But treasuries underperform, bank NIMs, net interest margins, shrink, credit tightens. We still haven't seen the credit markets move, materially higher. Although I do have a chart that's intonating a move higher, but it hasn't. So that's all there's to say about that. US dollar falls relative to rest of world. Well, that's not happening. We're actually percolating pretty strongly right now as U.S. government debt and interest costs erode confidence. But I still see this as a potential in any case. And then, of course, yields getting and staying above 4.3 in the 10 years that tell that bondholders are definitely worried. They demand a higher yield for the risk of holding U.S. treasuries. And then, of course, unemployment moves higher, and with it, jobless claims. So those are the kind of the levels that I look at very specifically. Real hourly earnings staying above 2, jobless claims getting and staying above 267,000. We're still not there. And the SOM rule, which is a trigger of 0.5% rate of change increase in the unemployment rate. So we've gone from 3.4% to 3.8%, but that's only a 0.4% increase. So we actually haven't triggered this, but the rule is in a nutshell. Let me just where is this? Where the 3-month here, I wrote about this a while ago. Here it is. When the 3-month moving average of the national unemployment rate rises by 0.5 percentage points or more relative to its low during the previous 12 months, would indicate that a mere 4% unemployment rate is now a recessionary threshold. So that's what we're getting worked up about, is being on watch for that. Now, I posted this for clients back in March, so we're still not there. So the recession risk still isn't a thing until we can kind of hit those targets. So that's just one way of looking at it. At least that's one way that I look at it.
Yep.
All right. Okay. So gamma on QQQ, we talk about this for clients, because obviously once we start to see these vol control selling funds lose control, but they're not. They're extremely good at this game. CTAs selling. There are particular levels that trigger selling and then really deeper selling. We have absolutely stayed above that just by sheer, I would say, NVIDIA excitement and the market just not having a reason to trigger a sell-off. We did have the issuance July 31st and the pullback for 3 weeks. That was great. And then we had a very strong technical bounce that was really, really not hard to size up, by the way. It was a really great bounce. It got excited, it moved higher, and now we're kind of consolidating that move and market's trying to figure out what's next. But the gamma level for the most part really has not kicked in, right? So we've really been flirting around the edges, but we haven't been firmly in the grips of negative gamma. That's when the market becomes much more susceptible to air pockets. And that's basically what we look for. What we're not there yet, which is why we talk not only daily and weekly with clients, but we're trying to find the triggers that could potentially pull that forward. So what are some of your potential triggers coming up on macro front over the next month? And obviously you got to talk about FOMC on the 20th.
Yeah, like I mentioned, like the data this week is pretty lackluster. I mean, we'll get some China data. We'll get China CPI on the 8th. So I guess that's kind of Friday morning our time. Maybe I might actually be Friday night their time. Maybe it's Friday morning our time. I'm not exactly sure, but so there's not really much in the way of data this week. But you do have a heavy conference schedule. A lot of companies reporting and not reporting, just talking about maybe giving updates. So and you have some central bank speak this week. Next week is much more important. You have the CPI release on the 13th. You have the ECB on on Thursday the 14th, and you have OPEX on the 15th, and then they have the Fed on the following week on the 20th. So, and the BOJ I believe is on the 21st. So plenty of data left in September. Obviously just started, and it's just I was watching Bloomberg this morning, and they led with the 50 people saying how September is always a month of turmoil, and the worst month of the year in September. And look, I mean, I think you look back historically, look at the worst performing month of the year, definitionally it is September.
Yep.
For most interestingly, I think, is that we came into the month with the VIX at the low. So really, there is not a lot of fear about what could happen in September, despite all this talk about September being a challenging month. So I think that's interesting. And I think, really what we're seeing is some of the cross asset markets away from S&P are starting to react to this kind of changing, macro world of stagflation, really, which is, slowing global growth momentum, but sticky inflation, leading to central banks kind of uncertain about, really what they should be doing. Should they be addressing the growth concerns, or should they be addressing the reacceleration of inflation, which is happening? I think part of that inflation reacceleration has to do with, this bifurcated world that we live in, where an increasing percentage of GDP and commodity production is being done by BRICS plus OPEC, and away from developed markets. And so, the US, the UK, Europe, Japan are having a tougher time, but less so the US, but the other three are having a tougher time dealing with, inability to procure resources cheaply to fund their economies. I mean, Germany's industrial base has really been hollowed out here because of moves in natural gas over the course of the last 2 years. And, big producers have moved out of country. And that's happening more and more in Europe. And so, look, I think we're in a place where if the dollar continues to rally and yields continue to move higher, it's going to, in a market where VIX is at the lows, I just think we're setting up for potential powder keg here. And it's not the zero gamma line was 44.98 or 44.97. We basically closed right at it today. So the market could very quickly move back into a negative gamma position, over the course of the next couple of days. And if vol picks up, we could get back into that setting again. And so, but really what I'm looking for here is a move in yields and a move in rate, a move in yields and a move in FX comes first. Then the equity move kind of comes after that.
Yeah. And some of this FX currency move, it matters. So for example, let me just kind of show you something. And we've talked about this before, but this, you mentioned Bank of Japan, the yen and some others. Make sure I got the right one here. This is the Indian rupee. Now, I know we showed this. I keep waiting for this to kind of like make a move, but this is on monthly. This is on weekly. You can see this very, very strong sideways wedge, and it's starting to break higher. It did pull back a little bit, and now it's getting supported, moving higher again. So that's the kind of thing that we're looking for, is some type of currency move that will then bleed into equities. Yeah,
look, India is a very significant energy importer. This currency is going to go. Dollar rupee is going to go. I feel pretty confident about that call. I think what you also had last week, I mentioned it in my chat, and I think on our call with the Edge clients, was about the Mexican peso. Mexico has been a place of very strong outperformance this year. It's been a big carry trade beneficiary. Peso has been probably one of the best currencies around, and the central bank basically came in last week and was like, yeah, no more. The currency is kind of getting too strong. We're going to change our hedging program. Already some talk about, whether or not they may or may not cut rates. So what winds up happening, I think, is what we're trying to focus on is you have, broad markets that are being driven increasingly by flows, increasingly by computers, algos, systematic flows that kind of go on and on and on in one direction and then another direction. And what we're looking for, or at least what I'm looking for, is when a fundamental actor comes in to trade against the price momentum. And so what that could be is a central bank comes in and says, nope, the peso too strong, we're going to do something about it. Or on the flip side, it was the BOJ last year, yen too weak, we're going to do something about it. Or recently, or just even with the oil price, right? OPEC and Saudi are saying, we want oil prices higher. They come in, they do something about it. Or a company comes in after its price of the stock moves materially higher and says, we're going to raise equity, right? So there are fundamental actors in the economy that exist that can trade against price momentum and often set things up for reversals. And I think this peso situation, has the potential to be something like that. You had other currencies today, like in Hungary, a big move, and in other currency in Poland, there's been a big move. And so all these carry trade beneficiaries that have been where folks have been benefiting from yield differentials and a strong currency now are starting to see those trades unwind. And that's how you get currency vol moving up. And that's how you start to get selling in rates. And then you get rate vol moving up. And then you get to see equity vol moves up last. And the reason equity vol moves up last is because S&P structured product vol and vol selling is, one of the biggest flows around. And it just takes a while before other fundamental actors start to do the 1 + 1 + 1 = 10 type work and say, all right, this is going to be a deleveraging. I need to get out of my risk. I need to move on my biggest risk, which was US equities.
Well, the interesting thing, and I know that not many here are interested in this particular wonky thing that I'm going to show you, but for me, I'm really answering a question at the same time when someone is asking about US equities having a correlation to the currency index. For me, it's very much dollar and yields. So let me kind of show you a case in point. This is something I show clients, which is it's a ratio, but basically kind of humor me for a little bit. This orange is the SPY underneath SPX, and then this blue is the indicator. And when it gets really, really elevated, by the way, this is again inverse, so you got to kind of keep that in mind. They tend to work really, really well as a market direction, and that's clearly a headwind when we have higher dollar and yields, and that's exactly what we've had moving very strongly recently, and the market hasn't cared. So the market has been moving regardless higher, even though yields and dollar have stayed quite bid. So there's a big divergence right here, which is basically setting up kind of an air pocket of risk. And I'm waiting for that to kind of trigger. So on a very, very short time frame, for those who are interested, this is what I mean by the SPX hourly gap fill, which is October 1st, after that Treasury issuance that Craig is talking about. We gapped down, and then we ran into the NVIDIA earnings, and then we kind of stabilized and we moved higher, and we're kind of just sitting in between this gap fill and potential rollover. I think we're actually going to have more pullback tomorrow, but this is on a very time, sensitive nature. Not everyone's looking at that. But for me, to answer your question, yes, dollar and yields are what I track constantly, and variations of them in ratios, just to see how the equity market moves, even on an hourly time frame. So it's very impactful. There's no question. And yes, to answer your question on home builders, they got crushed today. They actually, to me, looked like they were setting up for a rollover 2 weeks ago. And then they got that stay of execution. And then basically they popped, and then they dropped right back down. So there is, so much that they can do if the 30-year really starts to move higher above that 7%. They've done a lot. They've moved a lot forward as far as mechanisms of financing. Inventories, of course, very, very low. Prices are staying very sticky. But that was a very impressive reversal. I 100% agree with you. So I'm actually looking at this as it has the next level is follow through, and it could be a very strong trend reversal in home builders. But we don't have that yet. We just have a lot of shaking about. But yeah, it was a short-term correction. But we need to kind of break out those the prior weeks highs, so that we can see if we're actually going to get a stronger swing short in home builders. So yeah, that's what's so cool about, we had this incredible, when you're talking about uptrend since October is broken and most seem to have double topped, the whole market got supported, bonds and equities, in October of 2022. And now it's digesting that kind of liquidity that's waning, that Craig talks about and tracks. We definitely don't have earnings or any particular trigger, to kind of keep us excited. We have seasonality at the backs of bears potentially, and of course the FOMC, but they're not really pricing in any surprise hike. Let's put it that way. So we have gravity potential taking hold, and that was a very good observation. You're right. Home builders got crushed today. Pot stocks, they continued higher, but dismiss those as it relates to any economic impact. Uranium and energy continued to stay strong. So we definitely have some eyes on home builders over here, very much so. It's a good observation. Let's see, do we have anything else in regards to currency event, since we're kind of looking for a shimmy here in the dollar higher and its impact on global equities? At the same time, China is trying to kind of lighten the load for their consumers and incentivize capital market buying. Actually, they're kind of telling state banks to buy. It's not so effective so far. You talked about the peso intervention. Saudi Arabia wanting a higher oil price for sure, and making sure it gets there. But still, the whole kind of cross-asset review looks very strong on dollar yields, and equities are not responding. So just today, in fact, I saw the breadth starting to break down again and selling underneath the surface, which you can't really see in the price action, but it's what happens underneath, and I track liquidity on an intraday basis. So I think tomorrow we'll get a little shake and bake tomorrow, and we'll see if it follows through.
Yeah, we have a Bank of Canada meeting tomorrow, so we'll see how they react to this environment. They paused before the U.S. and then they reaccelerated, so that can be on the FX front. But I think China will be a big driver of this, and today was a decent reversal day in dollar CNH, back stronger again after last week's intervention. So be curious to see how things follow through there in China, but it does seem like the dollar is going to continue to appreciate. I mean, you basically have the strongest economy in the world, and you have the highest yields in the world. So it's not surprising that more capital is flowing into the U.S. I suspect that's aiding, U.S. stocks relative to the rest of the world. I suspect that's aiding, the tech story. And as far as bonds are concerned, there is certainly would be a flow into bonds, but that's being offset by foreign holders that are having to sell. And the Treasury is also accelerating its sales. So yes, there are flows into all dollar assets, but as other people have to sell more dollars, more dollar assets to raise dollars, then there's some pressure there. So I think the dollar is going to continue to be the wrecking ball that it normally is, and it's starting to show up in parts of the equity market, and we'll see if it can take out more of the equity market, including Qs and S&Ps, or if we have to wait until after expiry and kind of hear from the Fed on what I think is the most important part of the Fed meeting will be the 2024 dots, and how many cuts does the Fed want to embrace. I think that's the big key for that meeting. And maybe we can't unravel until then, but right now with the dollar moving like it is and yields moving like they are, I mean, look, IWMs are down 2% today. It's decent underperformance to start September, kind of just like they started in August down right away, and rallied into the end of the month, but still had a tough month.
Question asked on, how is VIX looking for a potential hedge? I am more excited about just the directional or spreads in the indices themselves. It's actually pretty darn affordable. In other words, right before we rolled over on August 1st, I had actually tweeted and talked with clients about how Bank of America came out with research saying it has not been this cheap to hedge in a year. So there was like, okay, signing up for that one. And it worked out. Obviously, the market pulled back for 3 weeks and it has since bounced. And again, we're kind of getting through the NVIDIA glow. But for the and the desks are going to be fully staffed right now that vacation and summer is over. So I would say they're back to being fairly priced again. So I actually see more bang for the buck in hedging in the indices than in specifically VIX. So that's one thing. I'm getting questions on NVIDIA because I've gotten a little bit of notoriety by asking the question, is the end demand real? And we're not using this show for that. But I do want to say NVIDIA has not rolled over yet. I mean, it's very clear. And a few weeks ago, I was like long Cisco, short NVIDIA. I didn't buy into the hype. And by the way, the investment desks didn't either pre-earnings announcement. But the point was, they have not rolled over. So there's nothing really, it depends on your time frame of conviction to say, yeah, they've given up. We've got some actual selling going on and price is cooperating. So on a weekly time frame, nope, hasn't rolled over. On a daily time frame, it's been spike high, spike low. It was a beautiful fade for the actual earnings day. That was stunning. But as it relates to price action, we have not gotten any signal for a confirmed short, but I still think it will. So, that's me. You do you. So add time or wait for the actual rollover. We had a really good looking intraday head and shoulders that was forming last week, but then it got defended. And then today it got pressure again. So we don't really, they're trying to stick the landing, and there are still many bulls. In fact, there are no analysts with a sell rating on NVIDIA. And you've seen the Bernstein, and I don't even know, Rosenblatt 1000 or 1100. It's very consensus bullish. So you have to weigh what, the questions I've asked and the videos that Nobody Special Jack has basically produced. I think they're more than educational. They're very insightful. And I think it just basically begs the question, how long before investors start to worry? But we don't have any confirmation of price action to the downside in NVIDIA. Cisco long, though, has been a great pair trade. Long Cisco, short NVIDIA. But this is going to be taking some more time. So, and we'll let clients know. And speaking of letting clients know, we do have a Labor Day special that expires at midnight today. And it's basically 15% off, whether it's for our community offering. We've got 3 products: beginner, intermediate, and advanced. I run the intermediate club offering, and Craig runs the MacroAdvisor advanced offering. So we literally have 3 different communities depending on where you are in your trading journey. So lots of mentorship, lots of trade setups, lots of analysis, also live and direct access. So consider that, please. And I'll find that particular promo, but I'm sure it's on my Twitter feed that James has sent out. So check it out if you're interested, because it does expire tonight and it's good for the life of the membership. Any final thoughts, Craig, on what you've got of interest that you're going to be, looking to trade, or looking for basically that surprise that you're always looking, obviously, on the.
Yeah, I think one other thing that wasn't mentioned, Japan had a 10-year auction last night that didn't go particularly well, and has a 30-year auction on Thursday. If I thought that there was a place where there could be some sort of issue that led to yields up even more, something out of Japan where that bond auction really doesn't go well and yields kind of spike higher on lackluster demand, and they forced all that paper into the bank's hands. There's been times in the past where those types of things have kind of exacerbated fixed income moves. So we'll keep an eye on that. But I think the dollar is going to continue to move higher here, and it's going to kind of act as a headwind for, this emerging market FX carry trades and emerging market assets in general. And I think as long as crude remains elevated, it's going to be hard for the market to kind of embrace a rate cutting cycle in 2024 that I think is necessary to keep equities up at 4,500. I mean, market's still pricing in, between 4 and 5 cuts for next year. The last dot plot, the Fed was kind of thinking around 4. I think there's a chance that it's going to get dropped to 3, in which case it could be a fairly significant, move in 2-year yields higher, and move in some of those kind of, Fed fund futures contracts towards the end of next year that move higher. That would be something that happens on the Fed meeting, but, would be a headwind as we kind of exit the quarter, when we know liquidity is being drained and there's a potential debt ceiling issue. We're possibly setting up for, something that doesn't look particularly nice in the back half of September, which historically is actually a fairly weak seasonal period, is that second half of September. So
excellent point. We actually didn't talk about that. No one asked about the debt ceiling, chances, but that is a risk, and that would absolutely spike equities. So would jobless claims on a Thursday morning above 267,000. So would NVIDIA selling. But the point is, we have to get one day at a time. And right now, I think we have the start of this new month. Officially, it was Friday, but nonetheless, we have really just, I think, covered everything. And the last question that just came in is inflation still a thing? In other words, number one issue for the Fed, or is something else on the agenda that they're worried about? I'm going to let Craig have the final words on this. I actually really feel strongly that they want inflation. They just don't want it to run too hot. And they definitely don't want to, disturb the equity market. But I don't think that this is going to be the question. I think they actually want inflation where it's entrenched. So it's making sure that we have that no landing. So far they've thread that needle pretty.
Yeah. I think they it's a pendulum for them too, right? They don't want inflation too hot, and they don't want there to be a risk that inflation runs too cold. They kind of want it, Goldilocks levels of inflation. And I think what winds up happening is the market reflexively reacts so violently in both directions, and it kind of actually makes the Fed's job a little more difficult, right? As the Fed has been slowing down the pace of tightening commensurate with the drop in inflation, the market gets super excited, bids up asset prices, and then inflation reaccelerates again because asset prices are taking up commodity prices, they're taking up PCE reading, they're taking up spending, the wealth effect, and it's making it harder for the Fed to accomplish that last mile to get to 2%. So, now that we're back down towards, the low threes, I think the Fed again is kind of taking their foot off the pedal here a little bit, which I think once again is allowing for inflation expectations to move up, energy to move up. And now we're getting another round of potential inflation reacceleration. So Powell did have the ability at Jackson Hole to slam the door shut like he did last year. He did not do that. So I think you could cynically say maybe they don't really want to destroy the economy to get back down to 2%. That being said, by half-assing it or by not getting there, they're allowing the long end of the bond market yields to move higher. There's a belief in the bond market that they may not get to 2%. And if they don't get to 2%, well, what if they stop at 3, right? And then if you have stop at 3 and you put in a proper yield curve and proper risk premium on a 10-year, you could see why people can very easily get 3 plus a positive yield curve of 150 basis points is 4.5, and some term premium is 50 basis points. That's a 5% 10-year. So that's how the market has reacted to this talk of changing the inflation target and not getting to 2% and maybe only going to 3. Is the bond market sells off. So I think that's been an issue for bonds for sure.
That's a going concern. All right, everyone, we maxed out our power hour. Macro to Micro, thank you so much for joining us and asking your questions. Hopefully we answered them to your satisfaction, and stay tuned. I do my Twitter stuff is very, very separate from what goes on in the trading room. There's not a lot of talk about in the video. And I know Craig doesn't talk about it. So that's for consumption elsewhere, but I appreciate very much the questions that you've posed to Craig and myself. And I wish you a great rest of the trading week. We'll do this in a few weeks closer to FOMC to kind of read those tea leaves. Actually, we usually do it on the Wednesday of FOMC. So we usually open up this right after. I think that's what we'll do again. So it'll be 3 weeks, but we'll get there.
Okay.
All right. Thank you, everyone. Have a great evening. Cheers. Bye.